Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, welcome to this episode of Through the Noise. My name is Heung, a senior investment strategist from the CIO office. Joining me today is Raymond Cheng, our CIO for North Asia. Hey Raymond, in our latest global market outlook, we started off mentioning that the market has been performing according to our expectations, such as, equity has performed well, gold has trended strongly higher, while the US dollar has fallen and US bond yield has largely been range-bound. So what do you think were the drivers and what do we need to monitor going forward?
Indeed, Ray, and as you described, right, it has been a result of improving growth expectations, supportive policy signals, and asset class diversification that we had anticipated. Now, in the US, attention has shifted decisively back to macroeconomic data. On the positive front, we are seeing a meaningful rebound in economic activities, especially in forward-looking measures like new orders in PMI surveys. Now, this tells us demand is stabilizing or even reaccelerating. However, the US labor market remains the weak spot. Despite some early sign of improvement, job data remains quite soft, and that matters a lot for the US Federal Reserve. This combination, which is an improving economic activity but still fragile labor market, shows support for the rate cuts from the Fed. Now, our view remains one that will ultimately be a tailwind for corporate earnings and risk assets. But even though our expectation of the next Fed rate cut now shifts slightly from Q1 to Q2 this year, the broader direction of travel still points towards easier financial conditions over the course of this year of 2026. Now, it's also quite important to note the uptick in economic activity data is not confined to the US, with positive signs visible in many other major regions. Japan's election outcome points to more stimulative fiscal policy. In Asia ex-Japan, policy in India continues to be supportive of growth and corporate earnings. In China, we expect continued policy support on continued signs of economic weakness. The one near-term risk would be higher oil prices and higher inflation expectations as geopolitical risk increases. While this can risk a delay in the next Fed rate cut, we do not see a significant risk to our base case scenario, assuming no sustained oil supply disruption.
Thanks, Raymond. Let's talk equities. We stated in our 2026 outlook that the AI rally is not a bubble. Do you have any changes in the assessment right now?
This has been one of the defining questions last year, and our view hasn't really changed after the past months. And that's because we think that the rally has still been largely supported by earnings fundamentals. As proven by the latest earnings season, U.S. corporate earnings as a whole grew at a very solid double-digit pace, and the tech sector delivered the strongest growth pace by a wide margin. That said, acknowledging strong fundamentals doesn't mean ignoring risks. Valuations are elevated, and the potential AI disruption effects deserve close monitoring. So we think there's real value in avoiding excessive concentration in AI and mega cap tech. That's why, even while remaining overweight US equities and still favoring technology, we advocate diversification into defensive sectors such as healthcare and utilities. They offer diversification and more balanced risk exposure if sentiment around AI continues to shift. Now, we have also added a new opportunistic idea on the U.S. aerospace and defense sector on strong aviation traffic and geopolitics-induced investment. Regionally, Asia ex-Japan stands out quite well, and we continue to be overweight in this region. Now, Asia ex-Japan overall has outperformed the US since we published our 2026 outlook, helped by US dollar weakness, and it provides an effective counterweight to heavy US tech exposure as well.
Yeah. Staying within Asia, where do you see the most compelling opportunities right now?
Within the region, India is quite interesting, and we have been overweight India equities since the end of last year. The market in India has lagged regional peers quite notably since the year started, but that underperformance to us actually provides a good opportunity to add, mainly because earnings expectations are improving. Policy domestically remains very growth friendly. And the completion of the US India trade deal also adds some earnings upside as well. And on top of that, a tariff reduction going forward could actually be a source of upside in the corporate earnings season. Now, the other country that we are overweight is China, albeit with a more nuanced view. The growth there remains a bit mixed, as seen in the recent economic prints, but policy outlook remains supportive. The broader environment increasingly favors cyclical and growth style equity markets. If policy support continues to be deployed selectively, risk reward should be quite attractive from here in our view.
Thanks, Raymond. Let's move to gold, which we actually have a lot of questions during our 2026 Outlook roadshows. Do we still like gold?
Gold has been one of the standout performers. While the pace of gains has been eye-catching, the underlying story hasn't really changed. Continued demand from emerging market central banks remains the clear pillar of support. And gold share of gold reserves, global reserves, continues to rise as well. Now, recent volatility likely reflects positioning and sentiment, while you might call animal spirits, pushing prices above trend before correcting back. Now, from a longer term perspective, the uptrend remains intact, and we stay overweight on gold, and we upwardly revised our 3 month target level to 52.50 per ounce.
Thanks, Raymond. Before we close, let's do a final stop on bonds. Any update to our bond recommendations?
Bonds have been much less exciting year to date. US yields have remained range bound, offering income but limited price action. Japan is the exception where fiscal expansion has pushed long dated yields higher, but we don't see meaningful spillover threat for now. Instead, we believe the divergence supports our view of a weak US dollar as US policy rates move lower against higher Japanese policy rates and unchanged policy rates elsewhere. Now, we still favor emerging market bonds, supported by better valuation and a weaker US dollar. At the same time, we are cautious on US investment grade credit, where rising supply, particularly from hyperscalers, could create some price pressure.
Thank you, Raymond, for the sharing. I think that's all the time we have. But in summary, we are saying improving growth and earnings. That's gonna offer room for optimism in in 2026. We will stay adding to U.S. and Asia ex-Japan equities. The recent corporate earnings provide very good fundamental support for U.S. market, while the Asian equities are supported by robust fundamental and also weak U.S. dollar. We're also saying stay overweight in gold. We're still expecting strong central bank demand and a sustained price uptrend. And the recent pause is an opportunity for underallocated investors to add exposure. So that's all the time we have for this episode Through the Noise. Please also refer to our latest global market outlook for more details. And we will see you in the next episode. And I wish everyone a very rewarding Lunar New Year of horse. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.